Gold is hovering near 5,400 as markets absorb a wave of geopolitical tension that has erupted across the Middle East. Silver is pressing toward the mid-90s, and both metals are testing levels that, for weeks, capped every rally attempt. What changed is not just price structure, it's psychology. Reports of missile exchanges, emergency alerts, embassy lockdowns, and regional mobilizations have forced traders to reassess risk in real time. Whether every headline proves accurate or not, markets move on perceived escalation, and perception right now is shifting fast. The 5,400 level in gold was more than resistance. It was the last stronghold for short sellers betting that fear would fade. Instead, fear expanded. Oil volatility spiked. Defense stocks surged. Currency flows began favoring safe havens. In moments like this, markets don't wait for official confirmations, they front-run uncertainty. And when uncertainty accelerates, capital seeks shelter. That shelter, historically, has been gold and silver. Hey, James here. This is Noble Metals. If you are new here, this is where I break down the data that the mainstream is not connecting. If you care about your savings, your purchasing power, your future, press subscribe button right now. This situation is escalating every single hour. Help me get this in front of more people. Over the past 24 hours, multiple reports have circulated describing missile launches, precision strikes, and retaliatory warnings across key flashpoints in the region. Governments have issued statements urging restraint, while simultaneously increasing defensive readiness. Some embassies have restricted movement. Military analysts are dissecting radar footage and satellite imagery. Even when details remain unclear, the broader takeaway for investors is unmistakable. Escalation risk has increased. Markets price probability, not certainty. If traders believe even a small chance exists that infrastructure, shipping lanes, or energy facilities could be disrupted, that risk premium enters commodity pricing immediately. This is why gold reacts before official casualty numbers are verified. It reacts to the possibility of broader instability, and once that risk premium enters the system, it rarely exits overnight. One focal point in current discussions is the Strait of Hormuz, a narrow passage through which a significant portion of global oil shipments flows daily. Even rhetorical threats concerning this corridor can jolt crude markets. If shipping insurance premiums spike or tankers reroute, supply chains feel it instantly. Higher oil prices ripple outward. Transportation costs rise, inflation expectations climb, and central banks face renewed pressure. That inflation expectation alone can lift gold. Investors understand that energy shocks often translate into currency weakness over time. Gold becomes both hedge and insurance policy. So when analysts mention Hormuz alongside military alerts, traders don't ignore it. They calculate worst-case scenarios and adjust exposure accordingly. Missile technology discussions have also intensified. Commentators reference advanced systems capable of evading conventional defense interceptors. Whether deployed or merely demonstrated, the perception of evolving weapons capability alters strategic calculations. Defense budgets rise, regional alliances tighten, and markets interpret technological escalation as long-term instability. The more sophisticated the systems described, the more investors assume that any confrontation would be costly and prolonged. Prolonged tension supports sustained safe haven demand. Gold does not need confirmed battlefield outcomes to rally. It needs elevated uncertainty about duration and scale. Reports of radar installations being targeted have further fueled speculation. Modern air defense networks rely on layered detection systems. Disabling even part of that architecture can shift regional deterrence balance. Financial markets don't evaluate tactical success. They evaluate what it implies for escalation risk. If one side demonstrates the ability to penetrate or overwhelm defenses, the probability of miscalculation rises. And markets despise miscalculation. That's when liquidity thins and volatility expand. In thin liquidity environments, gold often experiences sharp upside bursts as hedging demand collides with short positioning. Another sensitive dimension involves diplomatic compounds and foreign missions. Whenever embassies heighten security or restrict personnel movement, headlines amplify perceptions of instability. Even precautionary measures can be interpreted as signals that governments anticipate further tension. Investors, especially institutional funds, operate under strict risk frameworks. When geopolitical risk scores increase, allocation models automatically tilt toward defensive assets. Gold and silver benefit mechanically from that shift. It isn't emotional buying, it's rule-based rebalancing triggered by volatility thresholds. Energy markets sit at the center of this equation. If escalation were to extend beyond localized exchanges into infrastructure disruptions, oil could experience rapid repricing that would intensify inflation expectations globally. Central banks, already balancing growth and price stability, would face a renewed dilemma: tighten policy to combat inflation and risk recession, or ease to support growth and risk currency weakness. Either path historically supports precious metals. Gold thrives in policy uncertainty. Silver, with both monetary and industrial characteristics, often follows with amplified moves once momentum builds. Naval presence in the region has also become a point of discussion. Aircraft carriers symbolize deterrence and power projection. Speculation about potential targeting or counter-deployment immediately raises the stakes in analyst models. Even if no direct engagement occurs, the mere positioning of major naval assets alters perceived escalation ceiling. Financial markets translate that into duration risk. The longer tensions persist at elevated levels, the more likely defensive capital flows remain intact. That supports sustained upward pressure on safe haven assets. Ideological rhetoric can further complicate matters. When leaders frame tensions in existential or doctrinal terms rather than limited objectives, markets assume compromise becomes harder. Harder compromise equals longer standoff. Longer standoff equals prolonged volatility. Investors are less concerned with speeches themselves and more with what they imply for negotiation probability. Reduced negotiation probability increases tail risk. Gold is, fundamentally, a tail risk hedge. The more headlines emphasize hardened positions, the stronger that hedge demand becomes. Now, technically, 5,400 represented a critical structural level. For weeks, sellers defended it. Each rally attempt stalled there. That created a dense cluster of stop-loss orders just above. When geopolitical headlines accelerated, price pressed into that zone with momentum. If sustained buying forces a decisive break, short sellers are compelled to cover. That covering is not optional, it's mechanical. And mechanical buying can push price quickly toward the next major reference, 5,600. The prior all-time high. Above that lies what traders call blue sky price discovery. Without historical resistance, silver's positioning adds another layer. With price hovering in the mid-90s, a breakout could trigger algorithmic trend-following systems. Silver often lags gold initially, then accelerates once conviction builds. If energy volatility feeds inflation narratives, silver benefits from both monetary hedging and industrial demand expectations. A synchronized breakout in both metals reinforces momentum psychology across commodities. It's important to emphasize that markets do not require confirmed worst-case outcomes to move. They move on probability shifts. Even partial de-escalation attempts may not immediately unwind safe haven flows if underlying distrust remains elevated. Once investors adjust portfolios for risk, they rarely reverse that allocation overnight. That stickiness can sustain trends beyond what short-term news would justify. 3 forward triggers now dominate trader focus. Potential disruption to major energy corridors. Any indication of direct engagement between major military assets and signs of diplomatic breakdown spreading beyond the immediate region. Each would raise global risk premiums. Conversely, credible de-escalation signals could temper the rally. But until clarity emerges, volatility remains the governing force. So this moment is less about any single headline and more about structural repricing. Gold at 5,400 is not just a number, it's a psychological battleground between complacency and caution. If uncertainty deepens, 5,600 becomes the magnet. If stability returns convincingly, momentum could stall. But right now, markets are voting with capital, and capital is seeking protection. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth, and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make. Because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rare. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.